Let's look at salaries and wages. Now, when we first bring your historical salaries and wages information into your financial model via your accounting package, it's brought into the historical income statement into the salaries and wages section. In this example, we have 5 categories of salaries and wages information, with this currently being split out by the job level of employees. And we also have their historical salaries and wages expense information on the right-hand side of the sheet. Now, when we forecast salaries and wages, this is handled on the revenues and expenses sheet. Salaries and wages is located underneath revenue, and if you have cost of goods sold within your model, underneath your cost of goods sold analysis as well. As you can see, we have our 5 categories of salaries and wages information being brought through, and we use an average headcount and average annual salary to forecast our monthly salaries and wages expense. Looking at directors as an example, if we come across December 22, we currently have a headcount of 1 and an average annual salary of $167,111. Using this headcount and annual salary assumption, we're currently calculating that the monthly salaries and wages expense for directors in December 22 is equal to $13.9 thousand. We calculate this by dividing the average annual salary by 12 to get our monthly salary expense and multiplying that by the headcount. In this example, as we have a headcount of 1, if we divide 167,111 by 12, we get 13,900. To make this simpler to demonstrate, if I enter an average annual salary of $120,000, once I update this assumption for my director's forecast, we can see here that we then get a clean $10,000 per month as we divide that $120,000 by 12 to get $10,000 per month. When we look at the financial statement impacts of salaries and wages within a 3-way financial model, salaries and wages hits the income statement and the cash flow statement. Salaries and wages is an expense on the income statement, decreasing net profit after tax, and therefore decreasing the equity on the balance sheet. Similarly, salaries and wages is a cash payment within the operating section of the cash flow statement, therefore decreasing change in cash held. The change in cash held therefore decreases the cash at bank, decreasing total assets and therefore balancing the balance sheet. Hopping back to our example, if we want to see this 10.0 hitting our financial statements within December 22 in our financial model, we can head back to our table of contents and activate the financial statements. Looking at our income statement, if we expand our net operating expenses rows, locating our salaries and wages categories, again scrolling across the time series until we get to December 22, we can then see our 10.0 for directors' salaries and wages expense in the month of December 22. Similarly, if we scroll down to the bottom of the sheet to locate our cash flow statement, if we expand our cash payment section, we can then see under our salaries and wages categories our 10.0 as well for directors. Now, salaries and wages affects many other areas of analysis within a full 3-way financial model. This includes the taxes withheld on top of salaries and wages, commonly referred to as PAYE or PAYG. Superannuation must also be accounted for on top of the salaries and wages expense, and how much of this has been paid and withheld. We must also account for the provision of annual and long service leave. We must also calculate payroll tax and account for how much has been paid and how much is payable. And finally, the salaries and wages expense has implications on the tax expense of a business from a corporate taxation perspective. However, for the purposes of this video, when we're looking just at the impacts of salaries and wages is an expense on the income statement and a cash payment within the operating section of the cash flow statement.